you can't compare this to an investment because this does something amazing. When you borrow against the cash to pay for things like college, it continues to grow the rest of your life. So you are literally creating an asset for your child that's going to grow all the money that you put in for the rest of their life and pass on in an incredible way as they use it throughout their life. This is BetterWealth with Caleb Guilliams.
Hey everybody, and welcome to the next episode of On the Front Line with myself, Jereme, and the host of the BetterWealth podcast, Caleb Guilliams. I'm glad to be here because we are going to talk about something that's really near and dear to me. Some of you know because I mention them a lot. I'm a proud father. I have 4 amazing children, and we want to talk about and use this idea of consistency over time and how powerful certain strategies that we can employ are when you think about children as the true asset that they are, maybe that arrow in your quiver sort of mindset. And Caleb is going to start us off with a fantastic example of this from his own life. So Caleb.
So I know on the show we talk about a lot of things. We have our 4 principles. We have our BetterWealth model. You work with a lot of people in a lot of different scenarios. And a common theme is a lot of people do this strategy called the AND asset.
Yep.
Wrote a book called The AND Asset. And essentially, it's using a special type of life insurance.
Yep.
It's doing so in such a way where that your money will grow over time, long term. We talk about lifetime growth. It grows tax-free conservatively. But the other huge benefit is you can borrow against your cash to do other things like pay for college. That's an example that we're going to use today. House down payment, pay off debt. Your need for money is huge.
It's huge.
So one of the things that this was a book that I was like in the process of writing at the time, obviously a huge fan of this strategy. And this family came to us and they're like, our grandparents want to give the 3 children some money for college, and they want to know what they've been talking to different financial advisors, and we know you, we're working with you. We want you to talk about the AND asset strategy to them. And it was interesting. This was back when I would like literally go to someone's house. So I drove an hour to go and sit across the table, and these grandparents are super sweet, and they sit down. The grandpa's not super involved. The grandma's like, she's like, I checked some of your stuff out, and if this has anything to do with life insurance, I'm not interested. I'm like, okay. I was like, all right. And so I just explained it. I listened to what they wanted. And then I explained to them, I said, I know that you're not interested in this, but just let me share with you how the AND asset works when it comes to college funding. And I summarized it in saying, this is the gift that keeps on giving. Yeah. And they saw how it would show up in college. But then they also saw how it could serve them while they wanted to get their first house or their first car. And it also would serve them in retirement. And it also would pass on tons of money in the future. And we're going to show you some of that. So I just want to tee that up. And they not only loved it, but they walked away with 3 AND assets for their grandchildren. And I'm probably one of their favorite people of all time because I helped them see something that they didn't currently see, and they absolutely love it. So that's the story that I'm teeing up, and I'm excited because we're actually going to dive into to an illustration that is actually a real life illustration, and I'm excited.
It's amazing. I love this, and I want to highlight something. Caleb sought first to understand the person in that conversation, and many times we forget to shut our mouths and to listen and really pay attention to what the need is. Because if you can solve the problem, a lot of times the tool that you use to solve the problem is less important at that point in time.
Yep.
So I appreciate you because you do that in all of your conversations, from what I've seen, to seek first to understand. I appreciate that about you. So let's jump into this. Okay, so what you guys are seeing on the screen here is a life insurance illustration. And it's for a male who is 1 year old.
Wow.
Right? This is right from the get-go. And some of you may have read certain books out there that talk about this idea of generational wealth, family legacy, and how different families, companies have employed this particular tool to help set the stage in generations for their family to grow their wealth. So what you're seeing here is in this column.
And I also just want to point out, if you're listening to this on the BetterWealth podcast, thank you. We are showing our screen on YouTube, so you can check that out, and we'll do our best to explain what's going on if someone's listening to this.
Absolutely. So what this is a $6,000 a year contribution. Okay. And we say contribution because when you think of this as a payment to something, it changes how powerful it is. This is a contribution to a tool.
Wow.
Right? To a thing that has exceeding value as we move forward. So what those of you that can see this are going to see is that you're going to see there's $6,000 each year contribution all the way out through age 40.
Wow.
Okay? So just keep that in mind. And then within the function of permanent life insurance, there's this thing called cash value. And it can function as a reserve of cash that you can borrow against. Not from, but against. And if that concept is maybe a little foreign to you, go pick up the And Asset, and there'll be more information in there about that. But what you're going to see here is net cash value. The other thing is called a cumulative outlay. This is essentially how much money have I contributed to this thing over the course of time. And we're going to look at these numbers moving forward. And then we have a net death benefit. I spoke to an amazing mom just today, as a matter of fact, and we were speaking about this for her children specifically. And she got a little teary-eyed, and I said, "What's up?" And thinking about the mortality of your children may not be something that a lot of people like to focus on, but that's what it is. It is a death benefit. If they pass, there is a distribution that comes tax-free to the beneficiary on this particular contract. Now, the life-giving part of this is what you can do and how you can use this in your child's lifetime. And this is where she was able to overcome the emotion and go, okay, I see how valuable this tool is. And if we look at our children as assets, then we need to equip them with the right tools to truly be their number one asset. And this is a tool that can do that. So what you can see here is in the net cash value column is it grows over the course of time. All right. Some of you may note, if you're very detailed, that there's actually a negative rate of return to begin with, because this just simply means you don't have access to all of the money that you've contributed right from the get-go. But you'll see that as we go down, what we contribute here in the cumulative outlay becomes less and the cash value becomes more. And that happens right here.
Yeah, and for all the life insurance nerds out there like myself, the reason why this, I mean, because some people are analyzing this go, oh, this doesn't seem very good. And just stay tuned, because this is a 1-year-old here. This is a 1-year-old that we're doing this contract for. And the reason, I mean, they're just because all the MEC laws and all the behind the scenes laws that goes into it, they change. It's very much of a ratio of how we can design a plan. And so this is a very optimally designed plan for a child, due to a lot of constraints, and it's still good, but this might look different if you're someone in your 20s or 30s that want to get a contract. I guarantee you long term it's not going to look like this. Unfortunately, but short term you might have more cash. That's the only other thing I wanted to add.
Absolutely. And we're speaking specifically about children and this sort of thought process of seeing them as their number one asset from the get-go. And what is a tool, a maybe really efficient and optimal tool to start funding for your children? So let's look real quick at year 20 here. Age 21, year 20 of the contract. Okay. At this point, Mom and Dad, or maybe a little bit of Johnny, have contributed $120,000, and Johnny has access to $166,000.
Wow.
So in most instances, that's going to do things like help you start a business, maybe invest in a piece of property, go to college and get the majority, if not all, of your education taken care of. And we can have further dialogues. Guys, reach out to us. We can talk about how to exactly do that. And never forget that there's a death benefit here. Now, this is going into things like work and marriage and family and all the other things that happen throughout the course of life. This person, provided that this continues to get paid, well, and even in this case, they're going to have something to pass on very early to the next generation. And that's going to resonate with some of you. Some of you are like, that's not really a huge deal to me. And that's fine. But you can't discount it just because it doesn't mean something to you. So let's move farther down here and let's look at age 35. So we're at age 35, 34 of the contract. $204,000 has been contributed, and little Johnny has access to $447,000.
One of the things I want to point out, and this goes back to whether you use this account for college, whether you use it for a first car, or you pay off debt, is one of the benefits here is you can't compare this to an investment, because this does something amazing. When you borrow against the cash to pay for things like college,
Right.
it continues to grow the rest of your life. So you are literally creating an asset for your child that's going to grow all the money that you put in for the rest of their life and pass on in an incredible way as they use it throughout their life. And so, again, hopefully this is not the first video or podcast that you're listening to. If you haven't, make sure to check out the strategies, because this is definitely more specific in the weeds. Yeah. And this is incredible. So they're 35 years old. They've put a little over $200,000 in, and they have over $440,000 of cash value.
Absolutely. And let's not forget that establishing a good habit of saving, both as a parent and as a young person. Think about this, and I as a parent understand this. When my kids become of age and they are earning money, we are talking about, and we're going to have an episode about some of the things I'm doing with my children. We're talking about, what are you saving? They could be contributing to this and maybe should be contributing to this as well, to set the stage. This is an education platform as well, if you teach them how to use it properly. And that's the big piece, and that's why we want to be coaches in this capacity, because you not only have to set it up, you have to use it properly as well. So let's move on down here to statistical retirement age of 65. And again, retirement may not resonate with you as it does not resonate with me. This is still our cumulative outlay. You'll notice here, you'll say, hey, Jereme, why are they not contributing $6,000 a year anymore? Why is that, Caleb?
I'm not sure, actually. I didn't design this plan.
So we just can't get any more money into it at this point in time.
The MEC laws.
Right.
Yeah.
Right. So at this point, on this illustration, and again, this is just a snapshot in time, things change, but in this illustration, $2,076 is the amount that can be contributed moving forward. So let's take a look at year 65 cumulative outlay, which means what has been contributed, $289,000. And Caleb, what is that number there as far as cash value?
A large number. It's $2.1 million. I've learned not to try to say all the numbers on the pod, but it's over 2.1 million, which is a lot more than 200,000.
That's right. And I'm just going to real quick, because we're getting a little short here on time, and the illustration is so long because this individual is so young. So we have age 85. We have a cumulative outlay of $331,000. And Caleb, what is this number here for?
$5 million.
$5 million.
With a $6 million death benefit. So and again, man, I thank you so much for sharing this. And let's just go back to age 65. One thing that I want to point out is this person, if they wanted to, would pay a premium of $2,000, and their policy would increase by over $100,000.
That's right. Look at these numbers right here.
It's just one of those things where it's like, yes, we're with the and asset, we're not playing just a long-term compounding game. Though you can see it's pretty amazing. But we're not just playing a long-term compounding game, because we're saying you can utilize that capital to do some incredible things throughout your life, and your money can continue to grow. And this is really incredible. And I think when we take a step back, it's incredible for us. But if you can create a plan like this for your children, for the next generation, I mean, we look at studies like the Rockefellers, and they do this on every person that's born into that family has certain plans like this, created so they can continue to their wealth and pass on. The numbers are just dumb. It's like,
well, I mean, look at this later on.
Oh man.
And who knows what is going to happen in the next 85 years with regards to how long people live. We do know that if inflation continues to be a thing, what you're going to consume is probably going to be more. So I just felt impressed that as a dad, this was very, very life-giving to me to see that there are tools and strategies out there that if you have a long-term vision, if you don't just see the here and the now, but you can think into the future, may just very well have an amazing legacy and generational impact for you and your family.
Yeah, I just want to thank you so much for watching / listening to this show. We have seen some crazy engagement, and I'm just, man, I'm so grateful. When I started this, I thought, man, it would be nice if 10 people would listen, because that would be like a 10 million increase on who's listening. And it's just really humbling. Jereme, thank you again. This is super encouraging. And if you have any questions, any questions about your financial situation, any questions about a scenario, we are constantly looking for for content. One of the reasons that we're doing this podcast is we get so many questions from the front line, and we're not able to answer them all, or I personally am not able to answer them all, but this podcast is a platform that we can talk about certain things. So thank you for all of you guys that are reaching out and supporting our show. Any final words?
Like, subscribe, and ask a bunch of questions.
I love it.
We want to have a dialogue.
We'll see you tomorrow. Thank you so much for listening to the BetterWealth podcast. It would mean the world to me if you could hit subscribe, leave a review, and share this with the people that you know and love.